Welcome to another edition of the Best Business Minds, where we interview business leaders and academics who write thought-provoking books. I'm Marc Kramer, serial entrepreneur who consults with family businesses and entrepreneurs. And currently, I'm teaching entrepreneurship at Vinh University in Hanoi, Vietnam. But today, I'm in Lumberton, New Jersey, as I've been visiting family and friends here in the United States. Today's guest is Frank Buchholz, author of The Investor's Golden Playbook, 12 Rules for Achieving Real Wealth. Frank, thank you so much for joining us.
Thank you. I appreciate it. Thank you for having me on, Mark. Thank you.
Yeah, so before we get started about the book, why don't you give us your background, how you got to where you're at right now?
Well, I started in the investment business, if you will, as a financial advisor back in 1982. I worked for a company by the name of Smith Barney back in the day where John Howson was a spokesman, and he said, "We make money the old-fashioned way, we earn it." So if you're old enough to remember that ad, that's where I started. After about 2.5 years at Smith Barney, I decided to move on. I moved to a company by the name of Security Pacific National Bank in downtown Los Angeles, and they were acquired by Bank of America around the year 1991. I stayed there, and of course, ultimately, Bank of America acquired Merrill Lynch during the Great Recession of 2008 and 9, and I wound up my career as a Merrill Lynch financial advisor with the Bank of America as the parent company. Bottom line is, I was a financial advisor for 40 years. I saw the good, I saw the bad, I saw the stress, I saw the worry. It is not exactly, shall we say, the most stress-free career, but I made the most of it and I learned a lot. And upon retiring, I thought, why not write a book to fulfill two needs? Number one, of course, you need to have a sense of purpose when you retire. And number two, I'd done really, really well with my investments, considering I started with literally nothing. And I thought, well, why not, write a book and maybe help people out? And then, of course, ultimately, once we turn a profit on the book, I'm going to give all the money to charity. So it's kind of my give back strategy, if you will, to society. I've been very, very blessed. And, I want to pass the knowledge on. And maybe if I can turn a big profit, if I could sell 1 million books, I could certainly give a lot of money to some of my former clients who do great charitable work.
Well, I think it's great and it can't be more timely. As we know, the Supreme Court just turned over President Trump tariffs. And so give us just a quick take on what do you think about that?
Well, it's quite a big deal, and quite candidly, when he came into office, and he was talking about tariffs. I remember my economics professor back in college in talking about the tariffs and the Great Depression, which is one of the contributors to the Great Depression. And I thought to myself, I'm not so sure about this, Mr. Trump. I was not in favor of that then. And I'm certainly, I think that I'm relieved that it happened. But now, of course, you've got this how do you unwind it, et cetera. So it's going to be interesting to see how it all plays out here. And of course, the political fodder from all this is going to be pretty interesting to see how everything shakes out, if you will. So, stay tuned. But I think I'm kind of, I'm kind of glad to see it happen, to be honest with you.
Well, I'm sure Republicans in Kentucky feel like a sigh of relief that they don't have to go up against him because they've had to close a lot of plants down. In
Right,
Kentucky,
right.
they're making bourbon and whiskey and so forth, that most of their business, shockingly, is in Canada.
Yeah,
And
yeah.
so a lot of these things are going to be opening back up. And so those who were quietly not happy about these tariffs can now say, "Oh, well, the Supreme Court made the decision. I guess we got to live with that decision now, right?" So
Yeah, yeah,
that's
yeah,
that's
yeah.
that's how they're going to look at it. So it's talking about Golden Rule One: develop a prosperity mindset. You argue that wealth begins with mindset before money. What specific beliefs separate people who build wealth from those who struggle financially?
Well, I think one of the most obvious ones, in particular living in Orange County, California, where I live, so many people in Orange County, of course, live for today. Let's live for today, and let's go out and buy a fancy car and fancy house and get yourself all in kinds of debt and so on and so forth, and not have a care about saving money for tomorrow. I think the first rule, of course, is to put some money aside every month for your retirement. Uh, when I wrote the book, the one thing that really kind of surprised me was the fact when I read one day I was doing some research to illustrate my points was the fact that half the people in America today retire with no money saved for retirement. And I thought to myself, how short-sighted is that? Go through the entire life and not have any money saved when you retire. And of course, my wife and myself, we probably get maybe $4,300 a month in Social Security. Well,
Yep.
you know, not to sound elitist, but that wouldn't get us very far in where we live here. So I made it a point to save, 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 save. And when I retired, I grew my IRA to $8.5 million. And today it's worth about 9.3. And of course, I published a book a year ago, so we've had about a year to grow the account since then. But I've also taken out $460,000 in distributions because when you turn 73, the government requires you to take what they call a required minimum distribution. So we're taking out approximately $30,000 a month right now to live on. So, are we comfortable? Very much so. So again, I'm very blessed and very, happy. But bottom line, of course, is that I saved, and invested all those years. And of course, the money grew quite nicely.
And you literally, I just was there for a week at the end of January, and my daughters and I went out for hoagies, submarines for some of you, but from the Philly area, we know hoagies. Two turkey hoagies, two small bags of chips, three cans of soda, $71.
Yeah,
And we're
yeah,
talking about just a hole in a wall sandwich shop. And so, certain parts of the country, well, America's become expensive, period, especially after a pandemic and people moving from Silicon Valley to areas that were usually inexpensive drove up the price of everything. So now there's
absolutely.
no place that you go to in America that you're like, oh my God. Hopefully you've saved a good chunk of money. And I just read in the Wall Street Journal yesterday that the average people over 65, their average cash assets are 1.8, but when you take the billionaires out, it drops to 445,000. And that's what the real number is
Yeah, yeah.
445,000. And as you mentioned, half of America only has saved up enough money for 1 month.
Yeah, it's
Um,
terrible. It's
yeah,
terrible.
yeah, and we don't teach it early enough in school about money, right? Like the value of money. Maybe it should
No.
start like in middle school.
Yeah, it's just saying I should start because my parents really drove home the concept of saving, and of course I translated that into when I was a financial advisor, and I was doing that all the way along. I was maxing out the 401k. I'd also had a deferred comp program I put a lot of money into. So my my two biggest assets are my IRA and my deferred comp. My personal investment account would be number three, and then of course our house is number four. For a lot of people, the houses are the number one or largest asset. But for me, even though our house is worth, not to brag, but several $1 million, that's our least valuable asset.
Yeah. You tell powerful stories about investors like Leo Arenin. I didn't know who that was, by the way. What did Leo understand psychologically about investing that most people miss?
I think the bottom line, of course, is that Leo was quite the character. He was a dentist from San Jose, and he learned the value early on about investing in the stock market. He actually bought shares of Bank of America from APG&E, who was the founder of Bank of America way back in the day. And every time the market would go down, he'd come in and buy more, if you will. He had this uncanny ability to continuously have the courage to buy when things look really bleak. And that's kind of a unique gift, if you will, because most people, when things look bleak, that's not when they buy. They buy when things are really, really hot and really moving up and so on and so forth. But you kind of have to look at it like something you've been looking at, whether it's a commodity, whether it's a house on sale or furniture or clothing, whatever, and it goes on sale, that's the time to buy it. And it's the same with the stock market. When it gets beat up, that's really a good time to invest typically. So, and I always tell people, every time the market's gone down, every time in history, it's always come back and moved to higher highs. So, there is the fact that it's not a guarantee, but yet his concept was get those amateurs out of my way. I'm coming in. And I'll never forget, he'd tell me that every time he'd come through the door. And of course, he lived to be almost 103 years old. Of course, he lived in the desert, which I think is a very healthy place to live. But boy, he was on it and he was sharp to the bitter end in terms of his mindset.
Yeah, I always that's when I buy, and when the everything that's out of favor, that's the time to buy it, not when everybody is running into, or when Merrill Lynch or any of them would say, when any of them would recommend buying it, it's usually their clients are running out, and now you're buying at the top of the market, I think, when you're buying like
Could be,
that.
yeah. And of course, you got to you got to kind of watch the recommendations because nobody walks on water either.
Yeah. So why do you think Warren Buffett has been so successful? I mean, he's the most successful investor in the history of the world. Why, what do you think he's done so well that almost everybody else really hasn't?
Well, I think there are a number of people that have made money in the investment world, but one thing about him, of course, is he was very, very, very savvy. Uh, I mean, he actually helped both Bank of America and Wells Fargo during the Great Recession, and at one point, I'm not sure he's still there today, but at one point he was the largest shareholder of both those corporations because he was coming in and buying the shares and so on and so forth. Because Bank of America, for example, was trading at $3 a share during the Great Recession, and today we're 50 some odd dollars a share. So you can kind of see where even though we've had what 18 years have gone by, give or take, the price of stock went from $3 to 50 some odd dollars. That's quite a bit of appreciation. So but he has an uncanny ability in terms of his ability to pick things and to make things work, if you will. Um, so I applaud that, but I kind of get back to the concept of, if you want to invest in the stock market, I think the best way to do it, of course, is to have an outside money manager doing it for you, where they have a team of professionals and they are actually looking at it, 8 hours a day, working on investing, and you know figure out what they're going to do. The average person has not got the capability or the time or the energy or the savvy to do that. And of course, Warren Buffett had a amazing team, if you will, of professionals right next to him. So I think it comes down to professional management a lot of times too. So of course, he was the master at it.
I was wondering, I read the book Snowball, and I've read a lot about him. What was his process and methodology? Did you study, by the way, his process and
I
methodology?
I did not, to be honest with you, but I know he was quite ruthless, and of course he was a tough cookie to deal with. But I do not necessarily know his process per se. But candidly, when it comes to buying stock, there can only be so many processes. So I think when you look at stock, there's typically technical analysis and fundamental analysis. Fundamental analysis is looking at the earnings growth, sales growth, competitors, and so on. Technical analysis, looking at the chart and seeing where the chart is and where the resistance points are on a chart in terms of up and down, if you will. So there's only so many ways to, if you will, to look at things and to make a decision based upon what you're seeing.
I used to work with money managers, not financial planners, but money managers in helping them market their funds and so forth. And everybody uses some kind of computer system, some kind of program they developed. Even Madoff had a program for a while that actually worked for him, and then it stopped
Right,
working for him.
right.
And I've seen many money managers grow from 500 million to 20, 30 billion, and over a period of a decade go back to what the number was because their program stopped working. So, how do you know how to pick the right money manager, especially now that you have AI working for you and you can give AI criteria and let AI do it? So, how is that all fitting in today?
Yeah, that is a darn good question because when I retired at the 2021, if you will, we did not have AI so much in terms of on the sideline here looking at everything and everything and every concept out there, if you will. Uh, what I look, of course, is for a solid track record, and of course the money managers are more than happy to show you how they've done over the last 10, 20, 30 years, etc. And you want to find a manager that's done well through thick and thin and has had minimal downside, particularly through the tough times of the great tech bubble and the Great Recession, if you will. So, I mean, and of course, you could also look at the money managers in terms of where they're investing. Well, there's going to be a great deal more volatility with a money manager that's investing in the NASDAQ, if you will, i.e., artificial intelligence and computer and technology and so on, versus a money manager that's investing in well-established dividend-paying stocks, if you will, like 3M, et cetera. So it's going to be, so you can kind of pick and choose how you want to have those assets allocated, if you will. In my case, when I retired, I went 30% in terms of the NASDAQ type related stocks and 70% into the large cap dividend growers, if you will.
For listeners who grew up with limiting beliefs about money, what's the first mental shift they should make to begin building real wealth?
You gotta establish a concept of saving money every month and try to have it on an automatic debit if you can. In other words, if you're offered a 401k at work, make sure you sign up for that and make sure you invest the money in the stock market, particularly if you're younger. Now, if you're 59 and a half or what have you, then of course maybe you want to kind of maybe pare it back in terms of the stock market. But if you're 30 years old, the stock market has provided the greatest returns of any investment over the last 50 years by far and away. And yeah, we've had a lot of bumps in the road and so on, but the bottom line, of course, is the fact that the stock market has been the best place to invest by far and away. And of course, if you look at the money managers, you can certainly kind of pick and choose what you want to look at there, and that would give you, of course, some very very good ways to invest in the market. And if it's a 401k, for example, you can look at the mutual funds and pick the ones that have the best performances.
In Golden Rule 2, pay yourself first. What you've just been talking about is
Right.
absolutely pay yourself first. Why is paying yourself first more powerful than saving whatever's left over at the end of the month?
Well, I think yeah, what I was doing, of course, is every time I get a paycheck, I'd have money taken out, and in fact, to pay myself, which went into the 401k and or my investment account. So when I was working, of course, in a bank environment, if you will, I could simply easily move money from my bank account to my investment account, which I would do monthly, and then invest those funds. And in terms of the 401k, I would take that, of course, that would go into the stock market, every penny of it. So that was very beneficial to me because I was constantly investing over 40 years in the stock market. So that's kind of the concept. I look at paying myself first because that to me is absolutely vital. And that's the first thing that I would have priority to. Then of course once that gets paid, then of course I could take the other money and use it for expenses or living or what have you.
For someone early in their career earning modest income, how realistically can they implement this rule starting today when they feel like, hey, I'm just living paycheck to paycheck?
Well, that's a good question. I think a lot of people say, oh, they don't have enough money or time or energy. Um, you got to kind of somehow get the concept around you that you're going to ultimately retire at some point and you want to have a nice nest egg. So you want to make sure you have the money, kind of working for you. But also, some people say, "Well, I don't have enough money to invest." Well, in my last chapter, of course, in my book, I call it the Starbucks strategy. If you can somehow carve out, even $10 a day, which is typically maybe 2 cups of coffee at Starbucks these days. I don't go to Starbucks, but maybe it's a cup and a half or whatever. But the bottom line is you take out $10 a day, and let's say you're just kind of a beginning investor, you can put that into the Standard and Poor's 500 index, which is the ticker symbol SPY, and let that money grow for you. And then reinvest the dividends. And then, of course, you're basically buying 500 stocks. And of course, the S&P 500 index has averaged well over 10% through thick and thin over the last 50 years. So it's an easy way to do it. And you can have it set up on automatic debit, if you will. And $10 a day, most people can find $10 a day somehow, some way to invest. And if you've done that over the last 35 years, I include a calculator in my book, the little where you can calculate it on a website, you'd have over $1,300,000 if you did that over the last 35 years. So no guarantee that the future would be as rosy. Maybe it'd be better, maybe a little worse. But the bottom line is if you do nothing, you wind up with nothing.
Yeah, the people who just put it in a savings account, the bank, they're really cheating
Oh,
themselves
oh,
for the
horrible,
future. Yeah.
horrible.
When you yourself, when you own cars, do you keep them for 10 years? How do you not throw money away? Because I've had accountants tell me they've had clients made, 500,000, $1 million a year and have no money saved.
Yeah, again, it's that mindset, live for today. Live
Yeah.
for today, screw tomorrow. In my own case, it depends upon how well the car is doing, if you will. I've had some cars 10 years, some cars, less than that. Um, the car situation in my household may be a little different than most households. We have three expensive European sports cars in the garage. So we're a little different than most people. And of course, those cars are the three of them are worth more than I paid for them. So it's not, I didn't buy them as an investment, but the bottom line is they're worth more than I paid for them. So, and they don't have very low miles. And of course, my wife has a little SUV. But I do generally keep the cars that we have as daily drivers for probably, probably probably 7 to 10 years, depending upon reliability.
Golden Rule 3, build a strong foundation. You emphasize building a financial foundation before aggressive investing. What are the components of the foundation itself?
Well, the foundation, of course, I think would be bottom line is you want to make sure you have money that is not terribly wildly invested, if you will, from the get-go. In other words, I kind of think that you're going to be better off from the get-go by looking at some of the large corporations in America that pay dividends and have a history of growing those dividends. And there are money managers that actually do that for a living, if you will, that specialize in that. So that, of course, would be a good foundation for you. And then, of course, also too, make sure you have, your situation as far as your potentially maybe life insurance, have your estate set up, if you will, so that God forbid something happens, that your heirs are protected and they don't have to worry about everything quite so much. But bottom line, of course, is you want to make sure you're on track to start with this foundation. Then, of course, you can grow from there, if you will. So it makes a lot of sense, I think, to have this kind of this bar baseline, if you will, and then, of course, you can kind of as you grow with the accounts, then of course you can be a little more aggressive in terms of your investments, if you will.
Should someone decide between investing in stocks, real estate, or other assets early in their wealth journey?
I think so because you need time. Um, you know, I don't care what it is, whether it's real estate or stocks or whatever, unless you have somehow some genius faculty where you can buy, every stock you buy is NVIDIA, and you bought that 4 years ago. Uh, you need time to let things grow. So whether you're investing in real estate or stocks, time is going to be your ally. And again, not timing the market either. Time is your ally. So again, when you look at the stock market, you want to make sure that you have the ability to let that money grow for you and let it work for you, and you don't have to be running and going, "Oh my God, I need money today to buy blah blah blah." You want to let that money aside and keep it over to the side and let that money grow and grow over time. Um, so there's basically where you have your liquid monies and your investment monies. And your liquid money, of course, covers your expenses, emergencies, your daily needs, etc. And of course, you have your investment account whereby that money is set aside and you don't touch it.
Did you buy cryptocurrency? Because from the beginning, I just never really understood cryptocurrency, and I own no cryptocurrency whatsoever. And I know a venture capitalist who was one of the maybe be the biggest investor, and he was telling me when Bitcoin was $200 a coin. I thought, God, that's outrageous, even at 200. And I just don't get why I would buy cryptocurrency over just other they're all backed by dollars or some kind of currency. So I don't get it. Do you own cryptocurrency?
No, I never have and I never will. There's a number of things about cryptocurrency that scare me. Number one, of course, who you're buying it through. There's been quite a few, if you will, fraudulent people offering cryptocurrency. So that's one thing. And of course, number two, I mean, what is it exactly? I mean, you're kind of like buying tulips, back in the day in Holland, right? And of course, the volatility is not to choke a horse. I mean, if you go back to October 6th, the Bitcoin was $126,000. Today, we're at $67,000. So that's almost a 50% loss in a little more than 4 months. So, I don't see it and I don't like it, and I'll never go near it. Now, maybe that's totally wrong. Maybe I'm missing the boat here, but I just don't, I can't, I just don't see it. I don't feel it. I don't have a good feeling about it.
Yeah, I don't get it. I just looked up. There are 9,000 to 10,000 active cryptocurrencies worldwide.
Oh,
But I had read last year there were 22,000 cryptocurrencies. And unless they're tied there, unless it has some utility for something,
something exactly.
yeah, I just don't get it. And so I wondered if that was something that you had looked at. What about real estate? I know a lot of people who've spent their life at a very young age buying, rehabbing houses or apartments, holding on to them, and building a pretty sizable portfolio. My uncle just passed away, and he was an accountant that built a massive fortune in real estate, always buying when everything was out of favor, like really out of favor,
Right.
and then buying. But I think if for individuals who are buying houses and apartments, unless you have the skill yourself to fix them, um, an expensive proposition. So have you been a real estate investor as well?
My own home only.
Yeah.
Uh, I'll never
So
forget way back in the day, right? Somebody told me about real estate. There are three T's to real estate. It takes time, talent, and temperament. Time to go out and find the deal, the talent to, make sure you're getting a good deal, and the temperament to evict the tenants that aren't paying their monthly rent, if you will. So, and then of course you got to deal with the headaches and the maintenance. We have enough maintenance in our own house here, let alone, to deal with more real estate. So, and of course, generally speaking, and of course you can find exceptions to this, but generally speaking, if you go back to maybe to the, let's go back to the 50s, for example, the stock market's outperformed real estate in general. So, and again, with the stock market, you can go in and you can, have a managed account, for example, and returns have been better, and you just kind of, you don't have to worry about it. I mean, yes, you have to worry about it, but yet you don't have this asset over here that is subject to being flooded, burned down, or not, the tenant not paying the rent, or a million different things, if you will. So I was a firm believer in investing in the securities world, not the real estate world.
I made money buying real estate, like a few different things. But my biggest fear in owning real estate is in Pennsylvania. If the person you're renting to decides not to pay you, it takes you 9 months to a year to get them out,
Absolutely.
and you are still paying the bank, and you never collect from them. I mean, people
Yeah.
I've known who that's happened to never got any of the money back
Yeah. There
to
you
them,
go. And of
and
course,
they
I
can
think in
put holes
California
in
might
your
be worse.
walls.
Yeah.
Yeah,
Very
yeah.
difficult. Very
Yeah.
difficult.
Yeah, that's why I know people have made good fortunes like my uncle in that space. Um, Looking back on your own early financial struggles when you were starting it, what decision had the greatest long-term impact on your wealth?
Well, I think without question, of course, when I joined Security Pacific Bank, uh, we were offered the ability to invest in a 401k after I'd been there for a year. So I started my 401k in 1986, and I maxed out the contribution every year for the next 40 years. So that, of course, was a huge, huge benefit to yours truly. And every penny went into the stock market, and I never sold. And of course, I had some sleepless nights, particularly during the Great Recession, where my 401k became my 1.8k, et cetera. So it was a little challenging, but those funds kept every month, every paycheck. I put money in the 401k. That's why I grew it to when I retired. I had $8.5 million in there. So, that is, of course, I think a huge decision on my part that really worked out well. And of course, hindsight being 100%, I couldn't have been more correct in doing what I did.
So, Golden Rule 4, and this very much interests me, and I think on the listeners, find a financial advisor you trust. I mean, there's over 100,000 financial advisors, I think, in the US, and maybe the number is greater. I think that's what I looked up once. Um, how do you know who to pick? Because I meet a lot of financial advisors who just follow whatever the company's guidelines are. They don't even read that much about the finance world that give you really advice, because when the market's going up, everybody feels like they can be a genius. But when the market corrects, that's when you need your advisor to give you solid advice. So, what separates a great financial advisor from one who simply sells products?
That's a good question because in my book, of course, I point out the fact that is in general, I don't like most financial advisors. Most financial advisors, in my estimation, are arrogant sons of bitches, pardon the expression. So if you step back from that, of course, the first thing I would look for, of course, is uh, where do you even begin, if you will? So I think the bottom line, of course, is that you can look for referrals, maybe from an attorney, maybe from your CPA, maybe from one of your affluent friends, if you will, and ask him or her who they would recommend and interview that person. And I would interview at least three financial advisors. And the first thing I would look for, of course, in looking at talking to a financial advisor is, are they patient? Because so many advisors have this arrogance about them, and they're kind of like, they want to just slam you into some product typically a lot of times. So you want to look for patience, understanding, and the ability to communicate and to explain what they're recommending and why they're recommending it. So I think if you look at that, of course, and if you look at your own needs, you could even sometimes call up the branch manager of some of the major league firms, whether it's Merrill Lynch or Morgan Stanley or JP Morgan or whomever, and talk to the manager and tell them what you're looking for and ask him or her again who they recommend in terms of somebody on their own staff. So there are kind of a number of ways to do this, but boy, I tell you, in my case, I always try to treat every client like they were my best friend's widow. And by that, of course, I mean that my best friend was no longer here. Now I'm handling the widow's account, if you will. So my thinking was I would try to go out of my way to really try to be helpful and patient. And I had a number of clients over the years that would tell me that I could explain things better than anybody that they'd ever talked to in the financial world. So when you explain something 40 years, same thing over and over again, you become pretty good at it. So that's why I did my book. I became pretty good at explaining things so that people could understand it. And the investment book, of course, I wrote is simplistically written and I think very easy to understand.
And I think you're right. That's most important. Um, Madoff, when he was first starting out and he was getting assets, people were recommending him. I mean, very smart people were recommending him, and a lot of people were jumping on in the beginning, and throughout. He wasn't telling people he was going to make them 25% a year. The percentage he was telling them was pretty realistic, 10%. I think that was what I had read in a book about him. Do you think that you should, depending on the size of your portfolio, chop it up and maybe have three different people managing your money as opposed to one person?
I think that that's a good possibility. I'll never forget in 9/11, of course, uh, Morgan Stanley, of course, had, I think, 6 floors in the World Trade Center. And I remember at the time I thought to myself, are those clients going to be okay with their assets at Morgan Stanley? And yes, they were ultimately, thank goodness. But I mean, you can certainly, depending upon what the financial advisor specialty is. So in my case, of course, I had a lot of clients that had already made their money and they were happy with where they were, and they were buying municipal bonds to get income off of them, and it was using a preservation technique. And of course, I specialized in that area. So, of course, so it kind of depends upon what the advisor's specialty is as well. So having said that, yes, you can certainly do that as far as splitting things up. But going back to Madoff, uh, the bottom line, of course, is that Madoff was a small little firm. And I've always said that the fraud you're going to encounter, of course, will be in the small firms. So if you are with, again, one of the biggies, whether it's, again, Morgan Stanley, JP Morgan, Merrill Lynch, and so on and so forth, uh, you may not get perfect results, but you're not going to have fraud. And if there is fraud, it'll be it'll be taken care of post haste, believe me, because Mother Bank of America, where I worked, they were extremely conservative, extremely cautious, and they were very concerned about the reputation. So they watched the financial advisors like a hawk, and if there was ever an issue, it was dealt with immediately.
Question from the audience. What are your thoughts on seeking advice from a Vanguard advisor? I have a lot of my money at Vanguard myself. I receive occasional emails offering consultations on various issues.
I would certainly take advantage of that. And again, I think that, of course, Vanguard, of course, I think is another good firm, if you will. Um, I don't necessarily sort of necessarily know if every bit of advice they offer is perfect, like any other firm, of course. But I would certainly take advantage of the consultation, and just hear what they have to say. But if every time they have a consultation they're trying to sell you something, then maybe you want to maybe step back a little bit. I'd kind of I always look at those look at everything with a little degree of skepticism.
My ex-wife was one of the first 200 employees at Vanguard when they were managing, I guess, like 50 billion, and now it's like what 3 trillion, something,
Wow.
something
Yeah.
like that now.
Yeah,
Uh,
huge firm, huge firm. I mean, and there again, they have a number of ETFs, which of course is like this SPY I mentioned earlier,
yeah,
exchange traded funds, and of course, I even have a Vanguard, dividend paying ETF in my personal account for some of my smaller investments. So, they are a good firm, and I call them the Costco of the investment world because they're very, very, very sensitive in terms of fees.
yeah. How can people avoid costly mistakes when selecting professional financial guidance? And should you pick someone who gets a percentage of your assets, or should you pick someone that you pay a flat fee to? And I'm forgetting the two terms for each of these financial advisors that give you a plan, and you just pay for the plan, and they're not managing your money per se.
Yeah, so in my case, of course, the client had the option of doing either side of the equation, if you will. Um, Early on in the investment world, of course, it was all, if you will, client directed, meaning the client would pay a commission to buy or sell a security, if you will. And then, of course, as time marched on, uh, we ultimately had managed money. And of course, managed money, of course, was a percentage of the assets. So if the account grew, which of course is the money manager's objective, obviously, then of course the amount of money that the manager would be making would be less. And of course, vice versa. If the account did not do well and went down, or even because of the market conditions or what have you, the money manager would be making less. So you can do it either way, if you will. I think in the world where I was at, if the client was buying municipal bonds, I felt strongly that I could do as good a job as any money manager, and the fees were about a fourth or a fifth of what the money manager would charge over time. However, in the stock market, because the stock market is so much information and so kind of challenging, if you will, I felt that the money manager was a much better way to go for the most clients that want to invest in stocks by far and away. And there, of course, it was a percentage of the assets.
Uh, Golden Rule 5 is build a buffer. Why is having an emergency financial buffer so critical, even for wealthy individuals?
Well, I think bottom line, of course, is it gets down to, you know, the last thing you want to have happen, of course, is where you have this nice stock portfolio, and now, of course, you have an emergency, and all of a sudden you have to start selling stocks to meet the emergency and to pay for the emergency. You want to have this kind of this money set on the side over here to make sure that you don't have to run for the door and start pulling money out of investment accounts. The other problem, of course, you could run into, of course, is you may be ultimately paying a huge amount of capital gains taxes on the stocks you're selling to meet the emergency. And what's even worse yet is if you're younger and you have an emergency and you have all of your money in your 401k or your IRA account and you have to pull money out of that and you're not 59 and a half yet, you pay taxes, state and federal, you pay, of course, a penalty, and then of course, so if you have $100,000 emergency, you got to take out $200,000 pretty much to pay for the emergency out of the 401k or your IRA account. So you want to make sure you have enough money liquid so that you're not worrying about some crisis or what have you. So you want to kind of make sure you're planning, always kind of looking ahead, if you will, looking into the future.
Buffer should someone realistically aim to build before focusing on investing?
Well, I would say you probably want to have, you know, it kind of depends upon who the individual is, but I would say maybe, a percentage. You look at a percentage, maybe of 15%, or maybe a dollar amount as well. I think that maybe having, say in my case, probably, $50,000 is good. And that worked for me. But maybe you want to do a percentage too. So if you have, $200,000 investment account, Maybe you've got, 10% over on the other side of the coin, or on the other side of the ledger, which you could use for emergencies.
Yeah, I before the market collapse in 2008, and because I'm an entrepreneur, I put away 2 years of cash.
Thank God.
Um, yeah, and yeah, it turned out fine. The other thing is that I ended up pulling out all of my kids' college education because I was running a financial service company, and I kept seeing these credit default swaps and saying, "Wait a minute, there's like the emperor's new clothes. There's literally nothing behind these things."
Oh, it's
And
terrible.
yeah, and I was thinking a tsunami is coming. The only thing I regretted was thinking, my gosh, even if the market collapses, I still have 20 years to make it back. But what I didn't realize, and I think people don't, is when the market collapses and you lose 25% of your portfolio or some large number, it takes about a decade to get back. Like
Oh
even
yeah,
if the
oh yeah.
market snaps back, um, your portfolio doesn't snap back like that.
Yeah,
It could take
yeah,
a
it's
good
hard.
decade to get back to where you once were.
Yeah, it takes time. It takes time, no question. No question. Of course, credit default swaps, I tried reading those things way back in the day. I'd read the prospectus and I go, I couldn't figure it out. Literally, I could not figure it out. So I said to myself, there's no way I'm going to offer this to any clients. And thank God I made that decision.
Yeah, it was kind of like the 29 stock market when people were
Oh,
super highly leveraged and there was
oh,
nothing behind it. And then when the collapse happened, it was disastrous. Why are the biggest financial shocks? What are the biggest financial shocks you've seen clients face? And how did a buffer make the difference for them?
I think probably the biggest one, of course, we had, I think the was, of course, the Great Recession of 2008 and 9.
Yeah.
Um, and of course, that was pretty damn brutal, if you will. And I did have one client finally panic and run for the door. Um, so that was kind of challenging because, as a financial advisor, you're kind of stuck between saying to the client, "Hang in there," and then of course the market goes lower, then you got a problem. But if you'd hung in there, of course he would have been okay ultimately. But here we are. So that of course is certainly definitely a shocking situation, a shocking time, if you will. Um, and I remember that all too well, where we had more events happening on the weekend, it seems like, than during the week. It was very scary, to put it mildly. But bottom line, of course, is that the people that did okay through it all were the ones that did not have to sell and had the mindset that they understood that, again, the market, when it goes down, it has always come back. And there's not a guarantee, but it always has. And I'm thinking in the future will probably come back as well. But I've also adopted the mantra was was the fact that you want to stay invested, because I think the people that run for the door, now you're out of the market and you're going to be getting that puny little return on the money market. Well, you got to get back in at some point. So when do you get back in? So there's that, if you will. So, but the ones that did well, of course, were the ones that did not have to sell and hung in there and stayed with it.
Yeah, I think the same thing as well. That if you leave it like you did, like a lot of those people did, they never recover.
Oh,
Uh,
never, no.
yeah. Whoops. Golden Rule 6, keep your money protected. What are the most common forms of fraud and financial threats investors face today?
Where do you begin? Literally, uh, you know, um, there's so much fraud out there that you have to be a skeptic, and on everything and anything. Um, Even my little computer I'm sitting in front of right now, I got an email from State Farm Insurance. They says, "Oh, by the way, we'll give you a free, emergency kit. Just fill this form out and give me a credit card. Well, that'll pay for the shipping." Well, that was a fraudulent email. I've seen fraud with dating. My God, I had a client who she lost her husband and she got on some damn dating website, and of course the guy's trying to fleece her, and he's from Timbuktu. He crossed the globe somewhere. He wanted money, and so she gives him money, and oh my God, I'm telling you. And of course, you got Bitcoin issues whereby people hook up and try to buy Bitcoin, and they do it through a fraudulent firm. Uh, there's so much going on out there that you just have to be very skeptical. So, be careful on the computer, be careful on your iPhone, be careful with buying different types of assets, if you will. So I've seen a lot of it, and it's kind of sad because if people would use their energy to do things honestly, they wouldn't have to do the fraud.
Oh, yeah, no question about it. And those Nigerian frauds and all the other,
Oh, it's
um,
terrible,
yeah.
terrible.
And you do hear a lot of people who go on dating sites
Oh,
and that happens to them. Why do even intelligent and successful people fall to these scams?
well, it's kind of because they let their guard down. And of course they're trusting people, and then of course as soon as you let your guard down, you can get shall we say fleeced, if you will. So, uh, and I mean I've seen it happen over and over again, and some people have it happen whereby you know all of a sudden you get fleeced. And of course, in my own case, I check my credit card and my bank accounts pretty much every day, maybe every other day at the minimum. And occasionally I will find a funny little charge on my credit card of 99 cents for whatever. And of course, you kind of go, there we go, there's the fraud. So, we try to be super careful in the house here, but even myself, occasionally it'll happen to me. So, through no fault of my own, but here we are. So, bottom line is you just have to be super careful and you got to be kind of mindful of the fact that the world is a challenging place and there are a lot of people out to get you.
In Golden Rule 7, where the 8 pitfalls of money management, what's the single most destructive financial mistake you've seen repeatedly across your career?
I think the one I saw was bad was of course a client relying upon their CPA to make their investment decisions because the CPA mindset is a whole different mindset than of course the financial advisor's mindset. So that was where I found the biggest mistake, of course. That was definitely a pitfall. And I did have a client that lost a lot of money by relying upon his CPA. So it was, shall we say, a very, very challenging situation. So that would certainly be one of the major pitfalls, of course, of the money world, if you will.
Why do emotions often lead investors to make poor financial decisions?
They're looking to, I think they're looking to, get rich, if you will, quick, if you will. And there's so much, if you go on, if you, for example, if you go on Facebook, for example, all these ads about, these people that, oh, what, you just subscribe to my newsletter and blah, 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 we're going to make you a lot of money.
Yeah.
I mean, it's like, you kind of, I just shake my head and I go, oh my God, people, So I think what happens is that the emotions get the better of them, and in particular when the market's going down, you got to somehow have the courage and the guts to stick with it, stay invested, and to maybe continue, maybe step in and buy some of that when it's going down like that, because those are typically good times to buy. But again, it's easy to get caught up in the emotions and to make bad decisions. You got to look at things rationally.
How can listeners recognize when they're falling into one of those pitfalls?
I think the bottom line, of course, is it if they can't sleep at night, then maybe they got a little overexposed in the market. You got to kind of take it one step at a time when you're investing your money. You say to yourself, okay, now if I do this, can I sleep at night? And that's kind of my golden one of my golden rules is I didn't really mention so much in my book, but you gotta if you can't sleep at night, what's the point? So you got to kind of make sure that you can stick with it and hang in there, so that you're not really worried about your emotions taking hold, and have confidence, in America we've always come through it. Of course, right now we have all this political going on, if you will, and political firestorms, and the hate and screaming and yelling across the aisle here. But I'm convinced that we will get through this. We've gotten through a lot of things over the years, and I'm convinced we'll get through this as well.
Your wealth is bigger than your bottom line, which is golden rule number 8. You argue that wealth is about more than money. How should people think about the purpose of wealth?
Well, I think the bottom line in my case, of course, is the fact that um, uh, in my case, I had two charitable foundations that did a lot of great work. One worked with children, and one worked with in the medical world. And uh, I I came up with a concept of when I retired, I was now able to contribute to those organizations. When you're financial advisors, you cannot contribute any money to a client. And if I would have done this when I was working, they would have, shall we say, that could have been very challenging for my career. But when I retired, of course, I could now contribute to those organizations. And when you work with people on a daily basis, you get to know these people really, really well. So the bottom line is the fact that you want to get to the point where you can actually give to society and help others out with your money, because there's always going to be need, and the government, does a lot to help people out, but I don't think the government will ever have the ability to help everybody. So I think the people that can reach out and help those people across the aisle, if you will, that are having challenges, I think that's hugely helpful, and that's of course one of my passions. Right now we're at about $130,000 in terms of what I contributed to those two organizations since I retired. So it's not all the money in the world, but still $130,000 is still, it's a fair sum of money, let's face it. So I've been happy to do it. It gives me a good warm feeling.
Now, golden rule number 9, know what you own. Why do so many investors own assets that they truly don't even understand?
Yeah, because I got sold a bill of goods by a financial advisor probably. And again, maybe they weren't, maybe they weren't, it wasn't explained to them. But and again, in my case, I wanted to make sure that the client understood what they were investing in, and had a good feeling about what they're investing in. The, the, the problem, of course, is the fact that if the client does not understand what they're looking at, or what they're buying, it will have ultimately repercussions, and it's not going to be pleasant for either the client or the financial advisor, because I can hear a client saying, "Oh, you never told me that," or blah blah blah. What about this and what about that? And I mean, we try to make sure that every base was covered, and they had a comfort level. And one thing I would also do too when I had a meeting with the client is that I would always tell the client up front, "I will not ask you to make a decision today. So you come in, bring your trusted confidants, your attorney, your CPA, your spouse, whomever, bring them in. We'll have a good conversation. I will give you a lot of information to take home with you. You can study it, make questions, but you will not be asked to make a decision." So that's how I handle it. So that way, of course, we would have a good understanding right up front before they actually plug their money into an investment.
And now, of course, every financial advisor is being second guessed by AI because everybody's going to take that home and take whatever you've written, plug it into AI, and ask AI what's your thoughts about this.
Yeah,
And,
yeah.
and and of course, then you have to ask the right questions. So here, a question from the audience: can you talk a bit about tax planning? You mentioned that you are taking large RMDs every month. Did or would you have converted much of your IRA's 401ks to Roth plans? What are your thoughts on tax loss harvesting and taking gains off the table, but paying more taxes in the process?
Yeah, those are all good questions. So in terms of the Roth IRA, I did not do that. I kind of didn't want to write a check for, considering California's taxes and the federal income tax, I would have been my IRA my IRA would have been cut in half. So that kind of didn't really quite work for me. I think though that the Roth IRA is probably the greatest benefit of a retirement account that the government's offering us today. So I would highly recommend doing a Roth IRA. But again, with the Roth IRA, when you look at the taxes, if you're younger and of course your IRA is not huge yet, then I probably would do it. But in my case, we were writing a check for over $4 million, which kind of didn't wasn't terribly palatable, if you will. In terms of tax loss harvesting, that of course is a technique used at the end of the year to offset your capital gains. And it's something that a good financial advisor or money manager will definitely strive to do. Um, so I'd highly recommend doing that. And also make sure you're aware of the taxation, if you will, on investments. If you buy municipal bonds with the state you live in, the interest is tax-free, state and federal. If you buy U.S. Treasuries, it's state tax-free, but state tax-free only. If you buy stock that pay dividends, make sure most of those are qualified dividends, because your tax rate will be less than ordinary income. So there are some advantages there as well. But again, the best benefit the government offers, of course, is through a Roth IRA, which the money grows tax-free and tax-free when taken out.
So next question from the audience is what indexes are most useful? NASDAQ, Dow, New York Stock Exchange, international ones. What would they be?
Well, the one I use the most, of course, the one I like the best is the S&P 500 because that gives you a really good broad overview. The Dow, of course, is only 30 stocks. The Nasdaq, of course, is more of your technology-related stocks, if you will. So I like the S&P 500 by far and away the best. And of course, the international, the Russell, there's a Russell index, and there's a lot of other indexes. But I'm more of a buy American type investor. Um, until recently, the American stocks outperformed the international stocks dramatically. Now, the last couple of years, the international stocks have done a lot better, but I'm still kind of a, buy American type situation. So that may be totally wrong, but that's for me personally. So, that could be debated all day long as well.
So, as we're ending here, we're coming to a close. Uh, Now that everything has changed so much with AI and a lot of the way the financial managers and money managers operate, what kind of education should people get for themselves, and where should they go online to get educated? So they're making smart moves, so they really understand what their investment advisor is saying.
Yeah, that's really a good question. There's a number of good websites. One of them, of course, is Investopedia. That was a good one. I'm trying to think of some other ones here. Oh, Morningstar. Morningstar was hugely helpful. Um, that one is very good in terms of looking up information about stocks and mutual funds, etc. Um, I think that those would probably be two of my favorite ones at the moment. But if you just go in and type investment ideas or websites, there's a number of websites out there that are very helpful to you. So I would highly recommend a person doing that. Uh, Buy my book, read that, but a lot of investment sites are very good. So there's a number of them out there that I used when I was writing the book.
Is there any YouTube channels that people should be watching to hear what the latest are, and when they're even reading the Wall Street Journal and Fortune and Forbes and others, how should they be reading it in terms of educating themselves on where they should be putting their money, or at least being able to ask smart questions
Yeah,
to their financial advisors?
yeah. So I don't really watch YouTube, if you will, in terms of the financial advice, if you will, but I do read religiously the Wall Street Journal every day, and of course the Bloomberg Business Week. So I always read those as a way to kind of frame what I'm doing in terms of what my own accounts are, where we're at with those. So I look at those and say, now, how can I use this information here to benefit myself? So I would highly recommend, a person read those. I get the Wall Street Journal online. I read it religiously every morning.
Same here.
Oh
Yeah.
my God, that's my start of my every day with a cup of coffee and the Wall Street Journal. I would highly recommend that. I think the Forbes is another good one. I love Steve Forbes. I love his father before him, Malcolm Forbes. Forbes is a good publication. Barron's is a good publication. But I think if you have to read just one, I think the Wall Street Journal probably would be pretty darn good because they typically have a section on investing every day. So I would highly recommend doing that as well to kind of get a more informative. They'll give you some strategies in the Wall Street Journal as well, which are also very helpful.
Last question. What's the single action someone should take in the next 24 hours to change their financial future?
Either start saving or save more. And when I mean save, that means putting the money into an account that is used for investing and ultimately invest those funds in the marketplace. So I think that if you can somehow carve out more money and put that into the stock market, you're going to do much better over time than by doing nothing. So I think that would be hugely helpful for people. That worked out really well for yours truly.
Thank you so much for taking the time
Well,
today.
thank
I
you, Mark.
really
Yeah, my
enjoyed your
pleasure.
book, and I think it's so important for people to read about this so they can take care of themselves down the line, right? I mean,
Yeah, thank you.
I'm 65. My biggest concern is being able to take care of me so my kids don't have to.
Yeah, absolutely. Well, I'm 74, so like I should be by 9 years.
Yeah. Well, thank you so much. And thanks everybody for
My
coming.
pleasure, Mark.
And we'll see you all next week.